Hello everyone. Welcome to taxifindia.com. The budget of 2018 has trembled the nation. A situation of panic has emerged among people, and the panic can be clearly seen in the stock market. To clear all such doubts, we're coming up with an explanation on taxability of long-term capital gains on sale of listed equity shares. So, let's start. Before starting my discussion, I would like to make you all informed that long-term capital gains on equity shares arises when shares are sold after 1 year from the date of its acquisition. For simplicity, I'm bucketing my discussion into two parts. First is when equity shares are acquired before the 1st of February 2018 and sold on or after the 1st of April 2018. Second is when equity shares are acquired on or after the 1st of February 2018 and sold any time after 1 year. So, let's discuss our first bucket. When listed equity shares are acquired before the 1st of February 2018, that is before the budget date, and sold on or after the 1st of April 2018, then the newly inserted Section 112A of Income Tax Act would get attracted, and the assessee would have to calculate long-term capital gains as follows. Long-term capital gains equals to sales consideration less computed cost of acquisition. This computed cost of acquisition is different from the normal cost of acquisition. So, our next question arises, what is computed cost of acquisition? Computed cost of acquisition shall be deemed to be the higher of Roman 1 and 2. Roman 1 is the actual cost of acquisition or purchase value of such equity share, and Roman 2 is lower of A and B. A is the fair market value of equity share on the 31st of January 2018, and B is the full value of consideration received or accruing as a result of the transfer of the equity share. Let's understand this with the help of this example. Rajat purchased shares of XIS Limited on 17th Sep. 2016 for ₹1,000. He sold the shares on the 15th of April 2018 for ₹1,500. Fair market value of shares on the 31st of January 2018 is ₹1,300. Since the shares are sold after 1 year from the date of its acquisition, so long-term capital gains shall be applicable. Further, the shares are acquired before the 1st of February 2018 and sold on or after the 1st of April 2018, so Section 112A would get attracted in this case, and we have to calculate the computed cost of acquisition so as to arrive at the value of long-term capital gains. So, the computed cost of acquisition shall be higher of Roman 1 and 2, which is Roman 1 is cost of acquisition ₹1,000, Roman 2 is lower of A and B. A fair market value on the 31st of January 2018 which is ₹1,300, B full value of consideration which is ₹1,500, the lower of A and B is coming to ₹1,300. Now this ₹1,300 would be compared with the cost of acquisition, and the higher of the two will be my computed cost of acquisition. So, higher of the two is ₹1,300 which becomes my computed cost of acquisition. Thus, long-term capital gains would be sales consideration of ₹1,500 less ₹1,300 which comes to ₹200. So, as we can see, the government has not implemented this section retrospectively. The long-term capital gains which you have already earned before the budget is automatically getting exempted with the above calculation. Now, let's understand the calculation of tax on long-term capital gains. The government has given an exemption of ₹1 lakh on the amount of long-term capital gains. Anything in excess of ₹1 lakh would be taxed at 10%. Suppose, if long-term capital gains is ₹1,50,000, then tax payable on it would be rupees 1,50,000 minus 1 lakh, which comes to 50,000. Now tax at the rate of 10% would be levied on rupees 50,000. Thus, rupees 5,000 would be the net tax payable. Let's move ahead and understand our second bucket, which is, if listed equity shares are acquired on or after the 1st of February 2018 and sold any time after 1 year. In this case, the shares are being sold after the 1st of April 2018, so Section 112A of Income Tax Act would again get attracted, and the assessee would have to calculate long-term capital gains as follows: sales consideration less cost of acquisition. You must have noted that in this case we have deleted the word computed. Well, the government has specified the calculation only for the equity shares acquired before the 1st of February 2018, which was the budget day. Post-budget, if any share is acquired, then the long-term capital gains would be calculated in the traditional way, that is, sales consideration less cost of acquisition. As Section 112A is getting attracted, so tax would be levied in the similar manner, at the rate of 10%, after providing exemption of rupees 1 lakh. So, we're almost at the end of our discussion. Now, let's understand some important points. Bullet 1. Securities Transaction Tax, or STT, must be paid on acquisition and transfer of such listed equity share. So, if you are purchasing or selling shares outside the exchange, then neither Section 112 nor Section 112A would get attracted, and normal calculation of capital gains shall apply. Bullet 2. Benefit of indexation is not available on such long-term equity shares. Bullet 3. Slab benefit, rebate under Section 87A and deduction under Chapter 6A is available on such long-term capital gains. So, we're concluding our discussion here. We hope this video has been helpful. Should you have any questions, please drop a mail at contact@taxifindia.com. Like us on Facebook at facebook.com/taxifindia. Follow us on Twitter at twitter.com/taxifindia. And don't forget to subscribe our YouTube channel. Simply search taxifindia.com on your search bar and you'll reach us. Thank you.